My insurance was about $800 a door. My insurance goes from $800 to $1,800 a door overnight. Can't lose $150,000 in NOI. Every $100K in NOI loss at a 5.5, 6 cap is $1.8 million in value.
What do you think the biggest problem is when it comes to underwriting these deals in Florida?
The insurance industry has poisoned the real estate industry. Most sophisticated operators look at insurance as a line item expense. That's it.
What is a real example where changing the insurance structure improved the actual NOI and actually changed the value of the property?
So why are you paying $120,000 in insurance when it's triple net? Long story short, we fixed all that. We brought it down to $38,000 for the year.
What do lenders still misunderstand about the insurance, and how does that affect the deals getting done?
The guy doesn't have the capital difference because on a $100K difference, the DSR is below. You don't have to buy more property sometimes to increase the value of your property, increase your NOI.
But I'll kick off with the first question. I mean, insurance is no longer just an expense, especially when you're talking about Florida, right? Has it become a driver of the property value itself?
Oh yeah, of course. So you probably know my story, but I'll regurgitate it in about 30 seconds. So I came from New York, right? Lost everything on wallstreet.com bubble. And then I had a mentor and I started accumulating multifamily in Miami Beach. I got up to around 140 units. Let's just use 100 units for the example. Long story short is I came down about 140 units. Here in the States, if you're familiar, we're using Fannie Freddie a lot, right? Which are non-recourse loans. Why? Because you can underwrite on a spreadsheet, right? They're non-recourse, and as long as the rents and everything make money, that works. So what happened? So my insurance was about $800 a door, and when you use Fannie and Freddie, the insurance requirements are 80%, just to be frank, bullshit, right? Like domestic terrorism, 18 months of income, law and ordinance coverage. You need flood for the whole value of the building. If it's $5 million, why? I don't know. It's a big game that basically the banks own the insurance companies. And if you want to borrow money that way, you're going to have to spend 80% extra to get the funds, non-recourse, easy underwriting, because the insurance requirements are crazy. So long story short is we get two storms in 2005, Wilma and Katrina come through, and they came through Florida as category 1s. There was no damage. There was nothing, but they eventually went to New Orleans. So now December comes and I'm with a large national company, right? Like the Brown and Browns, the USIs of the world. And I'm waiting for my renewal. Where's my renewal? 3 days before my renewal, I get the renewal. My insurance goes from $800 to $1,800 a door overnight, right? So it's about $140,000 increase. And they're like, oh, this is the market. And by the way, we can't even meet your deductibles with the bank, and we can't do this. And if you don't take it, you're going to get forced place coverage, and you're in default of your loan, and yada, yada, yada. So what did I do? I didn't know any better. I bound the policy. So, and the worst thing is once you sent the certificates to the third-party servicers for these Fannie Freddie loans, because they don't talk to the underwriting from years before, they force place me on the difference. So let's just say it cost me around $150,000 extra, gone. And as being a real estate investor, you can't lose $150,000 in NOI. How much do they think we make? I was barely surviving at that point, right? To after that insurance debacle. So every $100K in NOI lost at a 5.5, 6 cap is about $1.8 million in value, or about $1 million off the loan proceeds if at a 6% 30-year AM. See, I said, how do I operate in coastal states when this happens? And disaster. So long story short is I took insurance in-house, and I understood that I had to understand the animal, right? And if you didn't, how are you going to be a real estate investor? And today, these what we call high-risk coastal states, they're everywhere. Right now, it's Texas, Alabama, Mississippi, Georgia, Carolinas, Florida. We had Superstorm Sandy in New Jersey, and ground zero today is the Carolinas. After what happened in Nashville, they're destroyed. They can't even get insurance, and they're all forced place on their loans. You saw what happened with the rain and all the storms there.
Sorry, just to touch on something you said. When it starts affecting the deal like that, and you said, for the viewers that don't know what you mean by when you brought the insurance in-house, that's your solution to the problem, which is external, right? Maybe if you touch upon that a little bit.
Correct. So at first I said, okay, I'm not going to let somebody railroad me 72 hours before, right? Which is very typical in this industry because That's how they do it, because they leave you with no choice, right? It's a commission-driven industry rolled up by private equity. There's no more independent agencies. So profit-driven, EBITDA-driven. So that doesn't help us as real estate investors. So when I brought it in-house, the first thing I said is, okay, I'm going to open an insurance agency. I'm going to get the licensing, get the contracts for the carriers. And I brought in this gentleman named Doug Levy. And I thought I was just going to capture commission, right? 10% and not get railroaded. So we did that, brought it in. And then I found out how big of a challenge it was to get in the insurance business, because they just don't hand out contracts, right? I remember, just to get Progressive, like a simple auto carrier, because you need certain admitted appointments and admitted carriers, like a Progressive, in order to get other appointments, right? So if carriers see you have 3 other carriers, then you start to grow. So it took years to get those contracts. We finally got them, and we took it in-house, and we understood how it works, right? Meaning the ins and outs of the industry, how reinsurance works, the structures of the entire dollar, right? So if I sell $10 million worth of insurance, for example, that's a program, and it's usually syndicated through a Lloyd's or a Scottsdale or a Beasley. And at the end of the day, if you send $10 million worth of insurance, about 18 to 22%, as high as 27, is commission, right? That's made up between aggregators, wholesalers, and retailers. There could be 3 people touching that to get distribution to you. And this is the E&S markets, excess and surplus lines. So you have about 22, let's say, percent commission. Then you have around 10 to 15% that's actually cat insurance, catastrophic reinsurance that they purchase. But it's not purchased for the entire $100 million worth of real estate. It's purchased for a maximum loss formula, right? So and most of the programs and most of the things that we do, they're lower risk. We're not buying Section 8 on the beach, right? So those programs, right, they take hits, they take losses. But the majority of what we buy, right, value add, 70s, 80s, 90s, even new construction, doesn't pose those risks. So at the end of the day, the reinsurance is 10 to 15%. There's around 5% admin. And then there's certain levers in insurance where you can make the insured who bought the policy pay the majority of the deductible. Really limit yourself in paying a loss, and then you inflate the premium by adding 80% of these coverages you'll never use, right? So that's how you inflate it. So at the end of the day, in the worst case scenario, even with a storm and you have proper layers, there's also a debt instrument in there. So if something big happens, it's a debt instrument that triggers a line of credit that you can pay something, right? The odds of this happening with an actuary in South Florida, less than 0.5%.
Good percentage, yeah.
That's the joke. That's like, so at the end of the day, you sell $10 million worth of property insurance. I'm talking hazard, wind, right? Not the general liability. The general liability is actually what you really need, because yes, people sue you, right? That you pay for, but it's a lot cheaper than hurricane insurance. It's 10 cents on the dollar compared to hurricane insurance, right? So at the end of the day, that $10 million even in a storm year, we have some claims, and you have some things to pay. You have a 40% margin,
That's
4
pretty, yeah.
million. And if you own the program, you capture the commission. So, and by the way, here's the best part of it, because I know, honest, you'll understand, is at the end of the year in our businesses, right? If we made 40% margin, 50% margin, $4 or $5 million on that, it's taxed, right? Right? It's corporate earnings. It's whatever you want to call it, right? It's not insurance, because it's considered insurance premiums, which are reserves for disasters, right? So you're building up the value of your insurance program. So that $4 million sits there, and then now the year's over. Now the law says you have to issue renewals, and it starts over. So you issue the renewal year 2. That's how it goes. So, or you don't have to, you can collapse the program, but then you pay taxes, right? Because you were collapsing it, but you have to give 90 days notice. And that's when you get those letters from the insurance carrier that says, we are no longer, you no longer meet our underwriting guidelines. So now picture this pool of capital, right? Now it renews again. And next year, now you're sitting on $8 million, right? Non-taxable because it's insurance premiums, right? And what do you do with it? You invest it. That's it. You invest it. You can invest it and make 4, 5, 6%. You can deploy it. You can borrow against it. You can co-GP. You can LP. You can do everything. And that's why the money business, which is insurance and banking, because the banks, they loan you money. They borrow money from the feds, and wherever they borrow it, then they lobby the government to make sure all of these insurance requirements are there. They standardize the forms. They do 90% of stuff that you'll never use. And then it's just this massive capital out there that you're forced. You want to borrow my money? You got to buy this insurance. And then that's why today some of the cheapest money alternative lenders is captives. They have the lowest cost of capital, period, because it keeps compounding, right? And at those margins, and if you invest it properly, that's why it's just cheap cost of capital. And that's how it works. So long story short is, you know, 2 years ago when Hurricane Ian came through, this is 22, it hit the West Coast, right? And really that was a flood event. That's the other joke, is new construction codes from 2000 and newer, they can take 250-mile-an-hour winds, right? And maybe, yeah, a tornado hits your building, but yes, maybe one out of 15,000 buildings, because when a hurricane comes, it affects 3 counties, right? So the odds are very low. So the point is it's just, you can lower the insurance requirements literally by 70, 80%. And yes, we can do it through private programs, but the other alternative is capital markets. There are capital markets that want to lend, right? But they're not traditional banks. They are credit unions. They are insurance captives. They are life insurance companies that when you can show them an actuarial model, there's no real risk. You don't need all this. So, for example, or they'll look at, like, I own this retail center here, retail office. It's 175 feet on Federal Highway here in Florida, but this building's 1957, solid concrete, roofs, windows, hurricane. And then I own the retail next door, 5,200 square feet. This is 2,800 square feet. The point is I paid $3 million for this place. I upgraded it with $400,000. This was 6 years ago. And then they passed a zoning law, the Live Local Act, which I knew was coming. Now I can go vertical. My land is worth $9 million.
Yeah.
Okay. So why do I need to spend $100K to insure 7,000 square feet? I don't care if they blow away. Right. And my tenants next door aren't even required to have insurance. So I raised the rent from $30 to $55 a foot, and the CAM is $8. Now they carry walls in insurance for liability and hurricane fund, but I got a new roof, hurricane walls, concrete building. This building's taken 20 hurricanes since the 50s, right? The only thing I do have is flood, because we got 26 inches of rain during a hurricane. We had water near our front door, but I got a concrete industrial floor. It's a cool looking building, right? I don't like, it's just
Yeah.
ridiculous. So the point is deals could not get done when those storms come in, right? Your NOI is lost. Your DSCRs are done. The brokers are finished. Every cap rate has to be redone, every asking price. And now this happens every 4 to 6 years in Florida, sometimes shorter. So we went up 300% in premium. The last cycle was 22 after Hurricane Ian, right? Why? Because they can. I know what the payouts were, and then the lawsuits and everything like that happened. The industry took a hit, but not a real hit. And then everything went up 300%. So what do you do if you're listing your property right there at a 5.5 cap and you just lost 100K in NOI?
Of course. And this is what I was going to ask you. What do you think the biggest problem is when it comes to underwriting these deals in Florida? Because I feel people are not underwriting the deals, taking into consideration the full impact of the insurance sector, which is the biggest fact. I mean, you chase away the insurers, you've got nothing, right? So you've done really well of bringing it in-house. And this is what I kind of was hammering on about this previously as well, but now people are feeling it. So what is the biggest mistakes people are making in their underwriting process or approaching any deal?
The problem is the insurance industry has, let's call it, poisoned the real estate industry. Why? Because even the most sophisticated operators, okay? I'm talking about guys with $1 billion in AUM. They look at insurance as a line item expense. That's it. They get 3 or 4 quotes, right? They see one's different than the other, one's this. And that's how I was able, by the way, to recruit my COO, who was a Manhattan developer who built billions over 30 years. He was the guy writing those $1 million checks for development for real estate in Manhattan. And all it was is, hey, my guy at USI or Marsh, last year it was 1.1 million. This year it only went up 32,000. And then they just say, okay, right? Because they have a loan. They have to meet a requirement. There's a deadline. But why, if you have such a large expense, right? Which is in Florida, it's higher than your property taxes most of the time. And it's either your single or your second largest expense. And it's not, management, electrical, utilities, turnover, none of those are. It's taxes and insurance, and then away from debt service. So why wouldn't a sophisticated investor start thinking about it? That's what was shocking to me, right? Like, how do you just accept it? So for me, I wouldn't accept it. When I brought it in-house, I learned the animal. I learned how it works. I learned, how to build strategic, partnerships with alternative lenders. And today, it's actually a strategic edge for me, right? Because if I'm buying a 20-unit multifamily even, right? I'm closing on a 14-unit at the end of the month. It's off market for tax purposes, but the guy's insurance is $42,000. I looked at it. I was like, it's like $2,300 because he's had the same legacy broker for 4 years. He doesn't even think about it, right? I looked at it. I'm buying a 6 cap off the guy. His rents are low. We'll stabilize it higher. But I already know going into the deal, I'm adding 22,000 in NOI just on the insurance piece. And my lender, who is a credit union, 5 billion, 15 states, they've already reviewed the deal. I own the building next door. I'm really doing an assemblage with income. And they agreed to waive the hurricane insurance. So that's going to reduce it even more. It's going to bring me down to like 9,000. Why? Because they know the value of my assemblage is worth more than the multifamily structure, right? Because my assemblage is next to the hospital, the vertical thing, and I own 3 consecutive lots. And if I choose to, I can cross collateralize. But what do I have there? I have general liability because I have workforce housing. And yes, they will sue me if a piece of drywall hits them in the head, right? But those are small claims we mitigate in-house with an in-house attorney, right? Or just pay $5,000, right? And get them off the books. So that's the game. But like, you buy insurance, go call an insurance broker and ask them what NOI is or a DSCR, right? Debt
Yep.
service coverage ratio, and which lender should I use? And they have no clue, man. They're going to tell you, listen, you need sinkhole coverage, even though there hasn't been a sinkhole in Miami in 65 years. And by the way, last comment, you can't even make a claim, honest, because if you make a claim on BS, even if it's a $50,000 claim, right? Small claim, or the biggest real claims on property are water damage, meaning you have a 2-story building, 3-story building, somebody's hot water heater breaks, right? And it leaks. That's real damage. Drywall, this, whatever. First of all, if you have maintenance, you control it, you turn it off, you can put in devices now to control pipes. And now you have a $20,000 claim, right? You make that claim, next year your insurance will go up 30%. Or they'll cancel you, and they may not pay you because they'll always find an exclusion, right? Because the policies are so vague. So long story short, even in the claim process, I had a lightning strike, take out like 20 AC units right on the roof of a building. I paid for it. I put them in. I got to churn my units, right? I got people in there, right? Lloyd's of London was the policy. The adjuster came from Texas. Took them 4 months to get there. I go, I already paid for it. Just pay me back. 7 months to get a check. 7 months to get a check. So I'm not saying it's always like this, but there are good carriers out there. There are some good companies. And by the way, government is the other alternative that the open market refuses to use, because in high-risk coastal states, in Florida, we have Citizens. Texas has a wind pool. Carolinas have a pool. So that's when there is a real storm or damage or something stupid happens, that's where you go. But the open market won't go. Why? Because it only pays 4% commission and the process is 10x. But when that happens now, with Fannie and Freddie loans, we shift to government. So in 22, we shifted hundreds of clients to the government, and the rates were 5 years old because the wind pools in the states aren't used when there's open market capacity, right? When interest rates are low, insurance markets get flooded. There's a ton of capacity. And what happens is a storm comes through, you get canceled, or in this, you shift to government, which was not needed for 4 to 5 years. The rates are 5 years old. You cut your insurance in half again. Then the way government works is, then a year goes by, insurance industry says, okay, we're coming back into Florida. There's 10 new programs, 20 new programs, gets flooded. The way you start an insurance company in Florida, high risk state, is if you come in 20% below the government hands you the policies to get them out. And next thing you know, you got a carrier overnight. So we shift to government. My competitors make 300% on the increases.
Right.
There's just so
There
much,
is.
but no one talks about this. They'll talk about cap rates and buying multifamily and fix and flips all over the internet.
Exactly, exactly, and I wanted to touch upon that. I mean, give me a real example. You already touched upon one with the multifamily and stabilizing and improving the cap rate, but what is a real example where changing the insurance structure improved the actual NOI and actually changed the value of the property?
All right. So very simple. I can give you dozens of examples, but let me give you a
Sure.
simple one, right? We have a client who owns 6 Whole Foods, triple net, right? So he buys them, things like that. Whole Foods is owned by Amazon. Okay. Amazon has massive insurance captives. They're self-insured, right? So they form captives over a geography. So he's with a big company, again, like the Marsh and the Brown and Browns. And he's like, listen, I'm paying so much money, right? So we say, okay, let us look at a couple of them. So the first thing we do is we review the lease. Insurance guys don't review leases. Real estate
Mhm.
guys do. So we reviewed the lease and we see that the insurance requirements, that it's a Whole Foods lease. They design their own lease. Okay. And if you want to be the triple net owner of the building, you got to go with it. So he signs it. There is so much insurance coverage. There is 10 million in liability. They cover the parking lot. They cover the signs. They cover everything from the walls in, including their equipment, their kitchen, stoves, refrigerators. You've never seen how big their captive is, right? So you're like, great. So I'm like, so why are you paying $120,000 in insurance when it's triple net and they're paying and they have their own captive? So I look at the lease and then I look at his policies. First thing, the replacement cost value, okay, on the structure. Insurance is replacement cost value. It's not market value. It's whatever it costs to replace that structure. This is a concrete shell with a metal roof, okay, which is the least expensive construction type in Florida. We can insure that for around $90 replacement costs per foot, right? Let's say it's a 10,000 square foot building. That's $9 million. His Marsh guy read an appraisal and has it insured at $310 a foot. Why? Because if I manipulate the replacement costs through a program called Marshall and Swift, the premium goes up 300%. Number two, he's got them with general liability for the parking lot and the interior, double coverage. Okay. All you have to do is call Whole Foods, get your insurance certificates, make you an additional insured, cover you. He's got coverage on the signs. That's in the Whole Foods policy. Long story short, there were so many inefficiencies because they don't know any better. Why did this big company sell them all this stuff? And then, by the way, the thing sits on 5 acres of land. Okay. The 5 acres, he's owned that one for 6 years, is worth probably 3x of what he bought because it's in the downtown Orlando area, right? So I'm like, long story short is, and even the loan amount wasn't even that high, is we fixed all that, we reevaluated, canceled all those policies, and we brought it down to $38,000 for the year.
That's brilliant.
So, but think about it. So every $10,000 is $180,000 in market value at a 5.5 cap on a Whole Food triple net. Now he also can go cash out and refi, right? For every $10,000 more of NOI on a 30-year AM at a 6%, it's $100,000 more in loan proceeds. So we did it across his entire portfolio. He saved $300,000-400,000. So that's just one example. I could go crazy deep. We do it every single day, right? We had a person today, I saw the spreadsheet, it's called the schedule of value. They own 27 single family homes, SFR, right? Portfolio. They got referred into us. And what you do is each one's a separate LLC. You put it on a spreadsheet called the schedule of value. It lists the year, the construction type, the addresses, the square footage, and the replacement costs. Insurance works on replacement costs. So the first thing we do is we analyze that replacement cost, values, location, and everything. Then we analyze the rate per 100, what they're paying for insurance. Insurance and property is priced per $100 of replacement cost value, right? So you reduce the replacement cost value, you reduce the insurance premium. If you reduce the rate per 100, you reduce the insurance premium. So when you did an average, because he had 4 different agents, right? Some personal lines policies that were incorrect, some other ones. Why was he insuring certain houses at $135 a foot replacement cost and others at $260 that were all workforce housing basic? So what we did is we showed him, he's like, oh my God, this one's insured at 240 a foot. This one's 130 foot. This one's 160 foot. So first, just blend it. What do you feel comfortable with? 150 a foot. It can be replaced. By the way, something called co-insurance. As long as you meet 80% of the value of the replacement cost, there's no penalty. So that's another lever. So let's say the carriers consider 150, 160 a foot replacement cost. So you insure for 10% less and you just save 10% on a policy. And there's no penalty because co-insurance says as long as you maintain 80% or more replacement cost value, there's no penalty. It's an inflation guard. But you and I we would shave it by 10% to save 10% on the policy because even $1,000, it matters as an operator. Right. So see how deep I can get into this layer? It's really cool problem solving. And my biggest thing is I love to recruit from real estate side because if you're a broker and you're listing a multifamily, retail, whatever, industrial, the first thing you do is underwrite, right? To see the cap and you go through all their clients' expenses and then you list the property. Well, they're already doing that underwriting. The problem is they're not digging deep into everything to reduce expenses prior to listing. So what we do is we do what we call a one-page quote. So I'll do lunch and learns at CBRE, Marcus and Millichap about insurance, but it's not about insurance. I go in there and say, what's your strategic edge when you go get a listing? We have a good marketing department. We have a national presence. Right. We make good drone shots. Really? How about if you increase the guy's NOI or the seller's NOI? How? By lowering the insurance cost. Really? Yeah. Wouldn't he be happier? You can sell it at a higher price or a better cap. Oh, so that's what like it's so, but how come nobody talks about it?
Yeah, I feel that's not in the agent's realm, right? I've had many conversations with agents, and even when it comes to capital stacking or just a few steps ahead, right? And even hammering down on the expenses and the underwriting, and I come back with all these questions, and they're like, "Well, we never thought of that," and I'm like, "Well, why have you listed it? If you haven't thought about it, why have you listed it? Are you expecting a sale to fall from the sky?" And they've gone back, and I've always done this, and this just happened maybe last week it was a nursery in Florida. And then the acreage was great, everything was brilliant. Owners wanted to retire and get out. And after underwriting, I came back to the guy and I said, "Well, hold on a second. There's been anomalies in the ad backs because that's a red flag. And also, what are all these? All these are missing." And he went back and he said, "You know what? It's going to take them weeks to get this to you." And I said, "You know what? Forget it. No worries." And you could tell what sort of agent you're dealing with from that moment. Don't get me wrong. I'm not
of course
knocking all agents because you have conversations just like yourself at a very high level. They understand everything from top to bottom and you get things done quickly. That's far and few between. Right. That's less than 3%. Oh, I was a bit generous.
3%? You're being generous.
1%.
Correct.
I'll trust your numbers better than mine. But yeah, and it's always like that. But when it comes to the lender's side, what do lenders still misunderstand about the insurance, and how does that affect the deals getting done from the same side?
So we get calls from lenders all the time, right? That the deal's not penciling. The guy was in contract on 130. This happened. 130,000 square foot shopping center, Kissimmee, Florida, Winn-Dixie anchored, and they did the estimate on $121,000 with the underwriting for insurance. And then when the rate lock came And the hard quotes came 2 weeks from closing. This guy's 100K hard, right? No going back, right? Because the seller was that kind of thing. The Brown, well, I won't even say the name. The big companies, they deliver the insurance quote at 211, 100K off. So I get a call from this guy, Max at Goldman Capital. He's like, Jerry, we're going to lose the whole deal. The guy doesn't have the capital difference because on 100K difference, the DSR is below, right? We're talking about the guy is missing over $1 million in proceeds. So the broker's not making commission on that, right? The lender, because it's a broker who's involved. And he needs to come up with another $420,000 on the downstroke. So what do? So that was the lender actually on that one was Orlando Credit Union. And I dove in. So this is what we do. So that was a 1986 construction, Winn-Dixie anchored, metal roof, concrete. I showed them that the dirt value, so it was about a $13 million deal off the top of my head. And at that point in the market, this was in 22, it was bad. I said, how much is the loan amount? I don't know off the top of my head, 70% of that, whatever it is, $8.5, $9 million. I said, why don't we reduce the insurance to make it happen? So we did. So I showed them a model since 1986 and since the construction of the mall there's been 21 storms and hurricanes. And it's the original metal roof that has a 50-year useful life, does not need to be replaced. Yeah. And then I went back to them and I said, bank, review all the leases. Everything is covered. Everything. Walls in. All the leases are covered. Winn-Dixie's covered. There was a Marshall's in there. Everything is covered. So at the end of the day, you're insuring a shell. So similar thing. When they did the appraisal, the replacement cost value came in at 122, but the big company did it at $190 a foot. I convinced them on a Marshall and Swift, it's a software engineer, that I can replace the shell for 90. So immediately I cut the value in half. Then I said, hey, you want to loan this money, right? Yeah. I said, I can't get the number down under 100,000 unless you use the government. And they're like, the government? I'm like, yeah, Citizens here. But the max insurance on Citizens for a commercial property is $1 million. I can't cover I think it was 5.6 value for the structure replacement on the shell, right? And they're like, well, I go, but the other policies you're looking at, they're valued at like $9 million, not 5.6. And you have a 10% wind deductible at 900,000, which shows you're never going to get paid. And the bank's attorney's listening to me and the board. I go, you're better off taking $1 million from the government that only costs $32,000. The deductible is 2% on 5 million, right? Which is 100,000. And guess what? Chances are you'll get paid and the damage over $1 million or not. And I go, and then by the way, have you looked at the appraisal? They go, yeah. I go, what's the land value? They said, oh, almost the loan amount. I go, okay, so are you secured or not? Yeah. So long story short, they let me do that. They wanted to lend the money and the policy turned to $84,000. But see, who's going to do that?
Yeah.
You think an insurance guy's going to do that? No, a guy like me and you are going to do it because if it was our deal, you're not walking away from 100K hard, right? And by the way, that guy's he's a 35-year-old guy who sold a tech company for like 60 million. And now he's on a tear. And all those properties are called Emma, his daughter, Emma 1, 2, 3. Now he owns like 11 properties like this. And he's like, oh my God, where did I get you guys? I found you. Thank you. But nobody's going that far.
But how often do you see owners accepting these bad insurance terms simply because they think there is no other option, right? I mean, how often do you think is it majority of the time? Is it, far and few between?
No. So we do something. I created something and we trademarked it. It's called TAO, Total Asset Optimization. So we removed the word from the company insurance, right? Because when I go to a real estate seminar at IMN and I stand up on stage and 400 real estate investors, I go, who likes insurance? Raise your hand. Not one. Not one hand goes up. So the point is the people you and I are investors. We're entrepreneurs. You and I take risk every single day. You're buying a nursery to convert it into a trucking piece of real estate, right? There's risk involved. You may not get the trucks. You may the city may not allow the zoning, the permitting, they could change it. The seller may not have fully disclosed. I mean, come on. Everything we do is risk. We got married, right? Like,
Biggest risk.
like exactly. So the point is the first thing you do is you sit down and you say to the guy, "What's your risk tolerance?" Right? Are you 70 years old? You're retiring. You want to protect this stuff. And then show them an actual actuarial model. Lloyd's of London has been in business for how many years? They didn't go broke. That's because they understand risk mitigation, right? And so do you, and so do I. So, like, I'll give you one more example. We just did a 54 building portfolio in Palm Beach, Florida. Great family. They own 54 buildings. His first building was about 110,000 square foot metal structure in downtown West Palm, right? It was one of his first buildings. He paid like 2.5 million for it, like in the 90s, right? And it's still on a 30-year amortization. The tenant is a hurricane window manufacturer. It's got a fire kiln in it. The guy owes like $320,000 on the loan, something like that, right? His insurance is $134,000 a year because it's a 1970s out of date building, old roof, but there's a fire kiln in it, right? And that's what it cost, the liability. And I said to the guy, I go, that's like 4 acres of land in downtown West Palm. He goes, yeah. I go, what's the land worth? He goes, oh, my neighbor went to buy for $9 million. So what are you doing? Spending $137,000 a year destroying your NOI because you have a loan. And by the way, this same gentleman built 10 brand new fourplexes, brand new construction, 2019, new roofs, hurricane windows, debt free out west in a place called Green Acres, like 25, 30 miles from the coast in Florida, right? Workforce housing with no debt on it. So I said, here, this is what you're going to do. He goes, what? I go, number one, you're going to pay off that loan. Number two, where you're going to get the money, you're going to go see this credit union because those fourplexes, even if you go to any bank, it will be 25 cents on the dollar compared to the other building because of the new construction location and everything. And when's the lease up on your tenant? He said, oh, it's up in 4 months. I go, can we redo the lease so that they take the blunt of the insurance, but we're going to get rid of the wind, the costly stuff, but we're going to make him pay for the liability, right? And just do it and keep his rent stable, but instead of raising it, have him pay for liability. So long story short, that portfolio was there was a lot more buildings, right? It was 1.1 million total in insurance. After we moved all around the map, including refis, paying off, doing this, lease reviews, it was a 9-month process. Today, their insurance is $620.
Wow.
$500,000, which at his portfolio size, it would be 1.8 times 5, whatever that is. It's a $9 million increase in portfolio value on a sale. Just like that, by the way. And that's what I always say. You don't have to buy more property sometimes to increase the value of your property, increase your NOI. And by the way, I build ecosystems with guys like you and my podcast. If you watch it, everyone that I bring on is an operator that increases NOI somehow. Utility rubs, right? We have advertising platforms that pay the tenants rents, that pay you. There's so many ways to increase NOI when you're an operator and not just buying deals. And that's what most people don't. Real estate masterminds, we'll show you how to buy property. We show you how to do this. We show you how to scale. We'll fund the money. Okay, show me a high NOI and you will find a sophisticated operator who is tracking everything. Because if you can define it, you can measure it. If you measure it, you can manage it. You know your turnovers. You know your appliance life. Everything, right? So
yeah, this is why I wanted to speak to you because you know your craft inside out and you focus on the things that matter, right? The numbers, the underwriting, and actually structuring, which all of these gurus, they don't teach. They're running around teaching high-level surface stuff, and this is what's giving the industry a bad name as well, right? But you know who the serious operators are. But touching upon risk, you've said in the past that selling in 2007 was one of the biggest mistakes of your life. And what did that experience teach you about the difference between protecting capital and limiting compounding?
Cycles. I wish, well, whatever. I'm not going to hindsight, no regrets. So
It's all
the
a
point
lesson.
is it's all a lesson, right? God laid it out that way. Because if I didn't go through it, I wouldn't know what I
Right.
know today.
Exactly.
Right? You got it. But see, here's the most people don't learn though. They go back and do it
Exactly.
again,
Exactly.
right? So what I learned about was cycles. Obviously, I was on Wall Street right out of school, 22 years old. Yes, I had a little run with Jordan Belfort and all that good stuff, but I ended up, I didn't want to work in Long Island. I ended up in Lehman, Grunthal, all these other companies. They're the same. They're all the same, right? Whether it was Michael Milken back in the day, we were taught to call high net worth individuals and raise capital over the phone from Wall Street, right? I don't care if you're at Goldman, Lehman, Jordan Belfort, it was all unregulated back then, and it was all 8 to 10% commissions. I don't care. I was selling Disney, Intel, And by the way, if you bought them Disney, they got pissed that you didn't get them Intel or Yahoo
Yeah.
back then, or all these things. So I learned about the .com bubble. I made a couple $1,000,000. I bought a 1 bedroom, 1 bath on the Upper East Side, and I bought a 600 square foot 1 bedroom for like 180,000, something like that. But what I learned was I got caught up in it myself, right? We were selling a company called Webvan, which is Grubhub today, because the .com bubble just no one knew what the internet was, right? AOL went from zero to $200 a share, right? Because We Got Mail existed. Grubhub, a web van went from zero to $90 a share because we're going to deliver groceries on the internet. Meanwhile, this didn't exist. I still had a beeper, and I'm operating on a 56K modem. But see, we didn't
Yeah.
know that. You're blind to that, right? We didn't. So look how long it took for Grubhub to exist, because your phone, your tech, your right capacity. We didn't understand that Amazon needed cloud services to store. So these stocks went through the roof, made money, made a lot of money. And then in 6 weeks, I was wiped out. Done, margin call, all this stuff. But I had a condo, and I understand cycles now, the tulip cycles, right? That the irrational exuberance of the market. That's what Alan Greenspan used to say. But the best thing about Wall Street is I learned about money, the system of money, right? Debt, financing, commodities, oil, gas, politics, right? And how the whole system functions. If you walk in today, there's still Bloomberg all over my office, right? Because insurance, all of it. So I started over, I rebuilt. And then in 2007, I had 2 mentors and a partner, sold my condo, moved down with only equity. I used hard money, fix and flips. For me, it was fix and flips because I needed equity. I didn't need a cap rate. I needed fix and flips, right? I had equity. And then in 2007, we did condo conversions. We did everything. We sold, and we had around a $30 million equity exit there was 3 of us, right? And I said, oh my God, we hit this perfect, because I was so scared of losing everything that I lost. I had done it before. And now I worked another 7 years, 8 years. And I had an older gentleman partner, Wayne Blackburn. He used to read these economic newsletters. We used to get newsletters, right? That he used to pay like $2,500 a year for. And it was doom and gloom. And then we had Investors Realty, Old Florida Mortgage, and all our real estate holdings. The front desk receptionist, Lily, still remember, used to go into the computer and track the MLS for inventory, for multiple listing service, right? So we had it tracked. How many condos under $500,000 on the market, right? Inventory. How many closings per month? How many single families near the coast, away from the coast? We literally had it 21 metrics tracked. And then Wayne calls us into a meeting with my other partner, David. He goes, look, and you see this condo thing in Miami, right? Like 38,000 units, right? Of inventory. And then the closings were like this, and they started to slip
Yeah.
like this. So you could see there was 2 years of inventory on there. And this was, right before the GFC, because anybody can get a mortgage, right? We were flipping condos. We were flipping everything to freaking taxi drivers, to strippers. I mean, you name it. Like, they just had a
Yeah.
pulse. I mean, it was crazy. We were buying units for 40K in
Yeah.
Miami Beach, putting 20K in renovation, and selling them for 125 with 0 down. That's what was happening to anyone with a pulse, right? So we saw that, and we exited everything. We were even in the middle of a 22 unit condo conversion. We sold that to a Venezuelan group. We sold everything. and except for 2 or 3 buildings. And that's when I said, let's sell Investors Realty, Old Florida Mortgage. That'll be done. And now I'm going to grow. We keep the insurance business because we still had that, right? Premier was there with Doug. So we sold everything and my partners agreed. And then they took the mortgage and the investors. I took the insurance, sold, let's say 90% of the assets. Some of those assets I kept, small hotels, things like that. Okay. And I was, oh my God, the GFC happened. Everything collapsed, The Big Short, the movies, everything, right? It was right on the money. The market collapsed, the biggest recession since the Depression in the United States. I was speaking at all the investor conferences, all the small conferences, like, right? And now I look back and I thought at that point I was a genius. And then what I do? I paid a lot of taxes and I redeployed a lot of the capital in Central and South America. And I decided to go have some fun and learn to surf and buy some small hotels and scale out a hostel called the Chocolate. But then after you pay taxes, this, and then eventually I got divorced, you're broke again. But whatever.
Yeah.
So what I learned though is today is buy, borrow, die.
Yeah.
Right? The biggest and most sophisticated investors of our time, they don't sell real estate unless it's even this depends too, unless it's a market that's losing population, right? Unless the demographic trends are pulling out, they ride it out. And one of my mentors today, he always says to me, it's not the price you pay for real estate, it's the terms that are the most critical. And this is a 3rd-generation real estate person. And his mother was a banker, owned a bank and things like that. So looking back today, I thought I was smart, right? But I was scared. And that's what had happened. And if I would have owned those assets today, my God, everything's 5x'd from there. So the key is the most sophisticated guys, they understand how to ride the cycle because you can't stop and you can't worry about where are interest rates and where's the market's going to go. Because if you're going to continue to build this massive portfolio and a family office and wealth for multiple generations, you have to follow what those guys do. And by the way, some of my friends that held through that, there's an old saying like, if you owe the bank $1 million, you have a problem. If you owe the bank $100 million, they have a problem. And so some of the biggest guys I saw were able to renegotiate it, right? Hold off payments for a year because they didn't want these loans back. All these things. So the biggest players are usually today, I understand, they don't sell the assets unless the demographics of the city or the state or country are falling to pieces. That's why you're moving to the United States. And then
hey, it is what it is.
It is what it is.
You know,
listen, that's why New York City, rent control,
it's
right?
unfortunate.
You want to
Yeah.
move somewhere with rent? Right. It's just how it is. So, but and then it's buy, borrow, die. You know what that means? Meaning you buy the property, it cash flows in the beginning. Don't over leverage 70%, 80%, 60%, right? It depends on your risk tolerance. Be conservative underwriting for, vacancies a little bit that you can hold on. And then when the markets are good, you raise the rents and things are good. And then when the markets churn, you're holding on. But at the end of the day, you're getting depreciation off your income. And then after 4 or 5 years, even with 4% inflation every year, you should be able to cash out a refi on the building, pull out all your equity at no risk, right? And then park it with a new loan. And then you keep depreciating it. And that just, and then in the beauty of the United States, you do that over 20 to 30 years. Yes, you carry debt the whole time. Why? Because you don't pay taxes, right? You will make 10x on that building in loans, right? And then when you pass, you know what happens. The cost basis resets and my kids inherited the new cost basis and that's it. So like in December, I bought a 5-unit building for $1.1 million because I'm still classified as a full-time real estate investor. So I need the cost seg depreciation. I bought a 5.5 cap, but I immediately cost segged it because the insurance company made money, right? I had to offset my income and I got a $480,000 depreciation, which saves me about $161,000 in taxes right there. So that's the buy, borrow, die world. And the biggest players in the industry, they even filed bankruptcy and come back, Mr. Trump. right? That's what they'll do if they have to, like on his Taj Mahal, right? In Atlantic City and all that stuff. So that's what I learned. That, and especially if you're a developer, which is now the new realm that we play with, a cycle to build 3, 4 towers somewhere could take you 6 years, 7 years, right? And you have to make sure you time that out for penetration, lease ups, all of that, right? I mean, what you thought was going to be built in 24 months is never built
Sure.
in 24 months, right? And that's the builder's risk insurance side, by the way. That's 24-month policies, non-refundable, and then the extension costs you double. And it happens all the time because developers can't meet the deadlines because the city, the zoning, the permitting, the construction delays, the tariffs, the oil.
Everything. Yeah.
In 2007, it was GFC, right?
Yeah.
Today, it's these maniacs that can't relax, right? And allow the people of the world just to live together in harmony and be civilized. And
Exactly. Exactly. And all of that comes down to, whenever you're mentioning all of this, all of that, majority of it comes down to good underwriting, right? You could build all of this in. You could like, if you're looking at the deals from the proper lens and you're underwriting them properly,
correct.
you could do this, through day in, day out without worrying about market cycles. But I'm conscious of time.
Right.
I want to finish up by asking you this one last question. If you were to give your last 30-second speech to the world, what would it be?
That's a good question. My last 30-second, I've never been asked, and I've been on a podcast, right? My last 30-second speech would be probably something like this. There's going to come a time in your life that you realize that it's not about you, right? And that the most profound things that happen to me are understanding the universe and how it works. Let's call it. You can call it God. You can call it the creator. You can call it physics. You can call it whatever religion you are. There comes a point where you realize that life is not about me. So when I went to Wall Street, it was about me making money. It doesn't work that way. The universe doesn't work that way. God didn't create it that way. The universe works in a win-win symbiotic relationship. Like if I breathe out carbon monoxide, that tree gives me oxygen. If you and I have a good relationship, we do business together. We take care of each other, right? If I get buried in the soil, the bugs eat me, they poop, they make sure that the trees bloom. The point is we live in a system. And the system is the tides go up and down. There's no day without night. Once you understand the rules of that system and understand the laws of it, and you embrace it with your heart, with love, with kindness, helping each other, building legacy, all of a sudden life becomes easy, right? And it's just there's a purpose, and it's never about you. It's about everyone else. It's about how you can give back to the world, what problems you can solve, what you do for your children, your family, your neighbors, others. And when you see this and you go with those laws, the universe, God, he rewards you with more than you know what to do with, whether it's money, family, friends, love, right? And that takes a long time to learn. And some people don't learn, because I was a poor immigrant, right? That came from Russia, right? And my parents didn't know the language. And I thought if I didn't make money, I'm insecure. I can't keep up with anybody. And when I went out and did that, and I only thought all about me and no one else and all that, guess what? You lose it all, because you can't fight the universe, right? It's not about you. It's not about greed. It's not about selfishness. Take that to an extreme, you're a criminal, right? So that's my message is, once you understand that, everything changes and you sail through life with your sails full. So I'll leave it with
That
that.
was one of the most wholesome, honest, grounded last 30 seconds I've actually experienced. So thank
Thanks,
you for
bro.
that. That was coming from a genuine place, and that's what matters. And I hope the audience and viewers
That's
could
right.
see that as well, which I'm sure they will. But Jerry, it's been an absolute
Awesome.
pleasure. Thank you so much for your time. I've got a feeling there's many more
Thanks
of
for
these to
having
come
me.
anyway.